Hello, ORAT Nation. This is Dan Bird on Wednesday, January 10th, with a quick midweek update on the market, stock market, that is, not the housing market. So let me very quickly jump into it. Let's see where we're at. Share my screen here. So for those of you that are interested in my weekly newsletter, which is free, just go to the breakpointtrading.net and click on this button right here, and you'll get the newsletter, no charge. If you want to register your email, won't ask you for a credit card, but if you want to register your email so you get notified each week when it's ready, then go ahead and log in at the bottom with the $0 free newsletter option, and then you'll get notified. And then a lot of the other things require an annual subscription, but it's certainly well worth it. All right, so let's see where we're at today. S&P 500 had a little sell-off last week, but now we're coming back, and tomorrow is the CPI number. We'll talk about that in a second. But all of the indicators right now look like the market is ready not only to go higher, but to finally take out this all-time high at 48.18 that you see right here. All of the momentum indicators are moving higher, so I think we might have a good chance of taking that out. I actually think we're going to be going over 5,000 soon, and I'll show you why here in a second. So that's the market. Let me also take a look at, I put this in here, our current secular bull market. So I've talked about secular bulls and bears before. This goes back to 100 years to 1929. Typically, a secular bull market lasts about 18 to 20 years, and a secular bear lasts about 12. Here's the last secular bear that we came out of in 2009 was the bottom. 2013 is when we broke out of the previous high. And if you figure they run for 18 to 20 years, then we have anywhere from 2029 to 2033, somewhere in that range, for this secular bull market to continue. And these are the indicators that you can watch. This is on the front page of my website. Every single week it's updated. So it's that's how important this is, just to understand where we are in the super cycle, if you will. So if any of these three turn red, then we will start watching this to see if the secular bull has ended. Right now it hasn't. But one thing that I added was the current secular bull market that we're in. And what you can see here is this starts in 2009. And it's also almost a perfect channel heading up. You've got the bottom in 2009. You've got the bottom of COVID. If I draw a line between those two, and then duplicate the line and drag it up to near where most of these tops are. And then I also got the exact same line here in the middle. So in the center, you can see anytime we have a cyclical bear market, comes down to the center line. Even though COVID was cyclical, it was a dramatic decline because it's something that we hadn't seen before with a 100-year pandemic. And also notice that we went outside of the channel up here in 2021. And that was the signal that this would not continue. That is unsustainable. So when back in beginning of end of 2021, I was talking about the fact that the bull market was probably ending, and that we should be prepared for an extended cyclical bear market. And as you can see, it came right down to that center line and then started to move higher again. So where will this go? If it's going to go back to the top of this channel, guess where that is? That's at about 5,000. And that's where I believe that we are headed. So we're probably headed back to the top of this channel. Then we'll see what happens. It might get rejected and pulled back down, which would be normal. Could just follow the channel up like it did back here. So we'll see. But I think 5,000 is probably where we're headed. Okay, let's talk about CPI. Tomorrow morning is the inflation report, tomorrow at 8:30. The last month was 3.1%. The expectation is for 3.2%. I've talked about this for the last couple of weeks, that I thought it would probably come in at 3.2, and that it would definitely probably come in higher than the previous month. So previous month was 3.1. So I think 3.2 is what we're going to come in at. And the reason why is if we look at CPI headline, this is the 12-month window. This is how the CPI report works. Every time a new one gets added on, and a new one will be added on tomorrow. So that one will be a slightly higher number, but not very much higher. Most likely, that's what I think. But every time a new one gets added on, then the one from 12 months ago drops off. And depending on the change, the distance between those two will determine how much this next one will go up or down. And as you can see, the one that's dropping off is very small. So a very small change from a year ago. And that's the reason this is probably going to go higher to 3.2. Now, if you'll notice the one in February, it's a much larger one that will drop off next month. And the result of that most likely will be a number below 3, probably 2.9. It might actually be 3, but 2.9 to 3 because there's a big one that's going to drop off. And if commodities keep falling like they are, oil and gas, that's going to help it as well. So February, I think we're going to see a dramatic decline, but this one is going to actually go up. So we'll see what the Fed does as a result of that. The next Fed rate conversation will be February 1st. So that's why I think tomorrow will probably be 3.2. That's what the expectation is. I think it probably will come in at the expectation. And if it does, the market should be okay with that. Let's also look, something new that I just added here is a 33-year look at core CPI with the rate of change. And this basically just is a cumulative view. So the green area right here is inflation, basically. And as you can see, inflation doesn't really go down. When it does, you have deflation. And there were 4 times, this goes back to 1990, 4 times that we actually had deflation. In other words, the rate of change of inflation was negative. So 4 times we had that. The biggest one right here was the pandemic. There's the pandemic shutdown right there. But even more interesting is the 12-month rate of change down here below. You can see until the pandemic, till the end of the pandemic, inflation was running at less than 3% for over 25 years, less than 3%. We had a 100-year pandemic. That was a very unique situation. And everything that happens, everything that people talk about should be done in context that was a 100-year event. And as a result, we had huge inflation. And I think inflation, you can see it's already coming down, but I think we will be coming back down to 3. We might be below 3 in February. But very shortly after that, we're going to be back down here below 3 or in the 3 range. So, and that will be normal. And by the way, everything that's going on right now, you have to understand and put it in context with the market is getting back to normal. We are not going back to 0% rates, I don't believe. I hope we don't. The market is in a normalized pattern right now. Around 5% is normal. So it could come down. We'll see what happens next year. But everything that's happening right now is normalizing the economy. All right, let's take a look at another one that I just added, which is industrial production. This is very interesting. Let's see. Where did I put it? 33-year industrial production. So this is a chart of industrial production. And what you'll notice, and I've got GDP down here below it. And what you'll notice is, first of all, the Fed rate hikes, every time they start to cut after an extended period of raising rates, that's when the recessions happen. You can also see that industrial production drops off. But the times when industrial production starts to decline coincides with the times when the market declines. And that makes perfect sense because when the economy starts to contract and slow down, industrial production slows down and the stock market slows down. Same thing happened here. This was the financial crisis. This was the recession. This was the 2000 .com bust recession right here. This was COVID. So industrial production was already declining. In fact, it was declining for a full year, even before COVID hit. So we were already headed for this. And then COVID just accelerated everything. And the market went down there as well. But look where we are right now. Industrial production is not declining. It's just basically moving sideways. Now it could decline. It could come down like it did here. And we had a little bit of a sideways movement in the market when that happened. But it could just as easily go up. So I don't see any reason to think that the market is going to crash anytime soon. GDP is still strong, in fact. So that was interesting. Let's take a look at the VIX because I've added something to the VIX chart as well. The VIX down here. So this is the VIX. Anything below 17 is bulls are in control. Anything above 20, bears are in control. And if you want to be long in the market, you should not be in the market if the VIX goes above 20. The VIX is very, very low right now. And when the VIX is this low, what that means basically is the VIX is a measure of volatility 30 days out in the future. So the options market is pricing in low volatility for 30 days. When volatility is low, that means premiums are cheap. Sometimes people think that that is not good for the market, that the market will start to decline or start to crash because the VIX is so low. That's not true. The VIX is low for a reason. The VIX is low because volatility is very low. Everyone is pretty satisfied with where things are right now. You can see that it actually started to creep up and it came right back down below it again. In fact, I need to draw a green arrow because we just dropped again below the line. So the VIX is starting to fall once again. But a falling VIX is actually a good thing. Now, one thing you'll notice down here, I added in the correlation. So here's the correlation. When this is near the top, that means they are correlated. Normally, the market and the VIX move in opposite directions. So the VIX, if the VIX is coming down, then the market is going up. If the VIX is going up, like back here in September timeframe, August to September, the VIX is going up, then the market's coming down. So they are inversely correlated. And that shows you that down here with the correlation line near the bottom. When the correlation line is near the top, that means they're correlated with each other or moving in the same direction, which very rarely happens. Normally, when that happens, it means there may be a change in trend in the market. Doesn't necessarily tell you which way it's going to change, but it means it could change. So we've been coming down here the last few weeks, and it is not correlated, but it's starting to move back down again. So we may actually be nearing a breakout of those all-time highs right there. That's what I'm watching. Another thing that I was curious about, I found that IWM, which is the Russell 2000, also has a volatility index, and the NASDAQ has a volatility index as well. So I was wondering what would happen if I combine those two together in a performance chart, meaning they both start at the same point, and see how they react with each other. And interestingly, what happened was the beginning of this year, the Russell 2000 or small caps started to outperform the NASDAQ. So that's what we have seen lately. Small caps are starting to catch up. They've been lagging for quite a while. So small caps are catching up and they're outperforming the NASDAQ. So we'll see if that continues. I actually had a subscriber send me a note and asked me if I have a chart that shows the Russell versus the Magnificent Seven. This is kind of what that shows because the NASDAQ, the NASDAQ 100, about 40% of that is the Magnificent Seven, but it's not all of it. So I thought I'd take a look at that and actually created a chart that I'm going to add to the website. In fact, I may add this to my bias matrix so I can track it every single day. And this now tracks, I found an ETF that just tracks the Magnificent Seven, just the 7 stocks in the Magnificent Seven. It's called MAGS, M-A-G-S. So if you want to buy the whole Magnificent Seven, you can do that by buying that ETF. So I did a relative chart of the Russell 2000 versus the Magnificent Seven to see how they would interact with each other. And you can see here in December, or actually the end of November, the IWM, the Russell 2000, began to outperform the Magnificent Seven. But that has reversed just in the last 2 days. That has reversed now, and Magnificent Seven are starting to make a comeback. And in fact, I'm starting to see that in the Magnificent Seven themselves. And on this bias matrix that I have here, I'm tracking the Magnificent Seven as well, plus a couple of other ones. And you can see Microsoft just turned bullish today. So anytime you see a box around this, this is a short-term, mid-term, and long-term trend. And so the short-term today just turned from bearish to bullish for Microsoft. So if we look at Microsoft up here, we can see that Microsoft had a great day today. So it actually is getting very close to breaking out of that high. So Microsoft might be ready to start moving up. So, and that's the way to use these bias matrix charts. Whenever the short term changes, then you should start looking for things in that area. I have one up here for the sectors as well. And you can see technology sector just changed from bearish to bullish today as well. All this is very positive for the market, by the way. The discretionary was very close. I think it was within 10, basically a tenth of a point of becoming bullish. So this one probably will turn bullish tomorrow. This is where Tesla is located, by the way. Tesla has a bear signal right now. So if we look at Tesla, we'll see that Tesla is continuing to move lower. So it's not ready to start recovering yet, but it's one to continue to keep watching. So anyway, that's interesting. I'm going to put that into my bias matrix, which can be found here on the website as well. And I probably will put it right here in the intermarket relationship. So I have the discretionary versus staples. I have the Qs versus the SPY, transportation versus the Dow, growth versus value. And I'm going to add in Russell 2000 versus the Magnificent Seven and just see how we track. But again, this is updated every single day. You can see here, technology just changed today. Software just turned bullish today. Clean energy, interesting, just turned bearish today. What else is bearish? Gold turned bearish short term. And silver turned bearish in the medium term. So those metals look like they're starting to roll over. In fact, right here on the left are the charts for each of these. So if we want to look at gold, we can see right here that gold has been coming down. So when the 8-day crosses the 21, that's the short-term signal. So we'll see if that continues or if it recovers, but just gave a short-term signal today. So that's where we are there. I think that's everything I had to cover. For the rest of the week, actually, I want to show you one more thing that I covered last Sunday, and that is the put-call ratio. Put-call ratio, I'm not going to go into a lot of detail on explaining this, but when this comes down, that means there are more puts than calls. That means more people, this is more calls than puts if it's going down. That means more people are buying. And when it goes up, that means there are more puts than calls. You can see all through 2022 it was going up. Now it's dropping off a cliff and it's starting to go back down again. So the market typically has a really nice run, a bullish run whenever this happens. And that's happening right now. This is a long-term chart. This is a 253 day moving average, which is 1 year. And this goes back here to 2005, 2004. So whenever this starts to happen, when this starts dropping like that, then the market is ready to really take off like it did in 2021. So I think we'll take out the previous highs, and I think we're headed to 5,000, frankly. So just an interesting point. Last thing, I'll cover the Santa rally, because Santa rally has not done very well. Santa rally itself was negative 1%. Last 5 days was just barely negative 0.13%. You can see if you take it from the open 5 days ago, it was green, but if you take it from the close the previous day, it was red. And I was wondering why they use the close from the last day of December rather than the open from the first day of January. And I sent a note to Stock Traders Almanac and asked them that question. And they said that they typically have always done it this way because the close is pretty set in stone, but the open varies quite a bit because of the pre-market trading. So at any rate, it was basically flat. And I've got some statistics. Actually, here's the CPI report tomorrow. Here's some statistics. This is from Stock Traders Almanac. And these are years when you had two of them down, which is what we have now, and the full month of January was up. Then what happens for the rest of the year, the last 11 months of the year, on average, the year is up 15%. The full year is up almost 20%. So we don't know if that up January is going to happen yet. Now, if all three of them are down, then the average is only 0.2% for the next 11 months and a negative for the year, minus 3.6%. So we really want January to end higher. That's going to be really important. Another chart that I found very interesting is this one here, current inflation tracking the period from 66 to 82. And the dark blue line is the period from 66 to 82, and the dashed gold line behind it is where we are right now. So when this chart was created, it was still in beginning of December, I think it was. So I drew this line down here. So the year had not ended yet. Right, this blue line here with the arrow going up, this is basically the beginning of 24. So that's pretty much where we are right now. And if we keep on tracking the way this one has so far, then we should expect for inflation to continue to fall. But if it does continue tracking that way, then sometime in the middle of 24, this might start ticking back up again. And by the end of the year, it might be rearing its head. Now, this doesn't mean it's going to happen. This is just a historical view of what's happened in the past and how closely this has been tracking it. So we'll continue to track it and see what happens, but I just thought that was very interesting. Finally, this again is the January effect. This is when January performance, these are quartiles. So when the January performance this is all three signals. If it's flat, which is this third one right here, then the market normally is up 4%. If it's down, if the January, the third piece we're looking for, ends up being down, the market's only up 2%. For the S&P, the NASDAQ, about 1%. And the Russell 2000, interestingly, actually outperforms in both cases when these things are down. So maybe small caps are the ones that benefit for something like this. So we'll see how it pans out, but it'll be interesting to watch. I'll continue to track that on the website. It's right there on the charts page at the very top right here. You can see last year's 2023, all three of them were positive, but this year the first two are negative. We had a nice day today though, so that might help. So that's where we are. We'll see how things pan out for the rest of the week, and hopefully we'll talk with you on Sunday with Mr. Zuber. By the way, just real quick, looking at VectorVest, the VectorVest view gives 2 green lights today. So it had a very positive day, a lot more buys than sells, more advancers than decliners, and 2 green lights for VectorVest. And we may get a green light. We may get a third one tomorrow if the market continues to go higher. So that's all good news. All right, thanks everyone. Have a great week, and we'll talk to you soon. Take care.